So, why such confidence in it as an investment, aside from the fact that it certainly has worked really well and more people are kind of jumping on the bandwagon?
There's several different ways to approach that.
Yeah.
I would say that right now, it's best thought of as digital gold. So gold is, as people have said, a store of value for 5,000 years.
Right.
And gold is what people typically fled to when the governments tried to, inflate them out. And in the United States, Franklin D. Roosevelt confiscated everybody's gold in 1933. You had to turn it in or you went to jail. So they can't confiscate your Bitcoin because there's nothing, you hold it securely. As long as you have an internet connection, you can send it somewhere instantaneously at very low cost. And the reason I like the insurance company analogy is because if you think about, people talk about the intrinsic value of Bitcoin. This is a Warren Buffett argument, that Bitcoin has no intrinsic value. It doesn't have any earnings. It'll never pay any dividends. And so how do you even think about something like that? It is a new technology. It's something that couldn't be done before. But in any case, the answer that I have to that is, well, I mean, what's the intrinsic value of that Mickey Mantle baseball card that sold for $5.5 million? It's just cardboard, and it doesn't even have a legend. It could be counterfeited very easily. Or what's the intrinsic value of a Picasso painting, which is just canvas and paint, and maybe a frame, but people will pay millions or tens of millions of dollars for it. And so it comes down at the very basic level for supply and demand. So Bitcoin is the only economic entity where the supply is unaffected by the demand. So even with gold, if gold, which is $1,800 today, if gold goes to $18,000, there will be a lot more gold mined because mines that are unprofitable will become profitable. And so gold, which accretes today, the production of gold is about equal to about 1.5% to 2% of the total value per year. That's the same accretion that Bitcoin has currently. But this year, 2022, I think will drop below 1.5% on that. So only 21 million Bitcoin can ever be created or close to it. It doesn't matter if Bitcoin is 100,000 or 20 million, there's only going to be that many of them. So all you have to really believe is that the demand for Bitcoin will grow faster than 1.5%, over the next number of years, and the price inexorably will go up. So I've only recently been allowing myself to be described as a Bitcoin bull. I used to tell people, they say, oh, you're a Bitcoin bull, you own a lot of Bitcoin. I'm like, I do own a lot of it, but I'm actually a Bitcoin observer, and I'm observing its trajectory as a new technology and comparing it to the trajectories of things like the printing press, or the steam engine, or the railroads, or the automobile, or electricity, and it's following that very, not predictable, because it's not predictable certainly in the early days, a well understood path for the adoption of new technologies. And I think it was Stan Druckenmiller said earlier in the year that, and now he owns Bitcoin, by the way, but he said that Bitcoin was a solution in search of a problem. And what I've found amusing about that is every new technology is a solution in search of a problem. Because you have a new technology, then you try and figure out what you're going to do with it. And so, when we created the internet, what are we going to do with that? So the Defense Department had good uses for it, but it was tough for other people to see. But now everybody can see what the value of the internet is. Same thing with the internal combustion engine, which was very dangerous and all, but now that's taken over the world, and now we're going to move to electricity. So all kinds of technologies have to grow into their potential. And Bitcoin is, I guess if you want the theoretical answer to the question, is that's the work of Brian Arthur, Santa Fe Institute, and Stanford, who is kind of the leading authority on what he calls increasing returns economics and what he calls lock-in and path dependence in the economy. So his basic idea is that when technologies reach a certain dominance and they're the leader, it's almost impossible to dislodge them, even without a very superior technology.
And Bitcoin's there? Is that what?
That's what I would say I and the other bulls believe.
Okay, but why the outsized, why 50% of your personal net worth? I mean, I'm assuming that the other 50% is in like Miller Value funds, or I don't know how you've diversified. And
well, actually close to the other 50% is in Amazon. All of the rest of the investments that I have are basically there to support margin debt, because I'm typically always on margin, which means I can take a lot of volatility. Now I'm not obviously on deadly margin. I'm on using regular Reg T margin, and I've got a fair amount of margin capacity. But the rest of all the stocks could eliminate all the margin debt and have a fair amount left over, and then I'd have those. If I had to sell all those to pay off the debt, then still have Bitcoin and Amazon.
Bill, can you explain to me the concept of Bitcoin as an insurance policy?
There's 21 million shares of this insurance company outstanding. And every day that somebody wakes up and says, you know, I need some insurance in case something, you know, in case the government seizes all the gold like they did back in 1933. Or, you know, when Afghanistan, we pulled out of Afghanistan, Western Union stopped remittances. So if you couldn't get money, and it's still hard to get money in Afghanistan, you were in serious trouble. In Lebanon, the lira has completely collapsed. Venezuela is a failed state, and yet Bitcoin continues right along. That was your insurance policy against financial catastrophe of one sort or another. And what did the Fed do when the pandemic shut down all parts of, threatened to shut down all parts of the economy? The financial markets came unglued, and the normal relationships between cash and bonds and securities, especially asset-backed securities, got blown apart. And the Fed had to increase the money supply by 25% to keep those things from collapsing as they did in 2008.
Right.
During that time, the Bitcoin network functioned perfectly. There was no run on it. There was, you know, prices went down initially until people figured out, wait a minute, we've had a tremendous collapse here, and the Bitcoin blockchain is functioning without any interference at all. So I think that explains it, I think, in a way that many people can understand. If you want a little bit of financial insurance, then buy a Bitcoin or a part of a Bitcoin. The argument I get most often is, why not gold?
Right, which is considered to be an insurance policy against catastrophe historically.
So the answer to that is, in my opinion anyway, gold has gone from been around 5,000 years, so it's gone from, make up a number and say a dime, a nickel in today's parlance. And in 5,000 years, it's gone from a nickel to $1,850. And in 10 years, Bitcoin has gone from a nickel to $57,000. So why would I own gold? Especially since gold in the last 10 years has gone down. In the last 10 years, Bitcoin is the best performing asset category in the world.
So you recently marked 40 years in the investment business, and you know, how has the investment business changed as far as your approach is concerned, and how have you changed? How have you evolved over the last 40 years?
The investment business is, of course, radically different from what it was 40 years ago when I got involved in it. That one major difference is interest rates at that point in time in the United States were the highest in U.S. history, and now they're not just the lowest in U.S. history or close to it, but for most countries in the world, the lowest in 5,000 years. So complete radical transformation of the fixed income markets. In 1982, when I was at Legg we started our mutual fund, the Value Trust. The amount of money, and I'm going from memory here, the amount of money in actively managed mutual funds in the entire country was around $70 billion. And at the peak of our assets in the Value Trust and Cognate institutional accounts, we had $78 billion. So more money than was in the industry at all when I got into it. But what hasn't changed is that human nature hasn't changed, fear and greed haven't changed. And most importantly, we understand a lot more than we used to through the workings of social psychologists and behavioral finance theorists, how large numbers of people behave under certain circumstances, well-defined circumstances. And one of the things that we know, and it's been proven over and over again, is that the coefficient of loss to gain is 2 to 1. So $1 worth of loss in the market is twice as painful as $1 worth of gain is pleasurable. And as Warren Buffett often says, fear is contagious and spreads rapidly, and confidence only returns slowly, one person at a time. But what that means is when you have very dramatic negative events, that people tend to overreact to them, and that those are, you know, they're rare, but they're perfect buying opportunities. But I think those are the principles that aren't going to be changing, and that's why you can read Jesse Livermore's Reminiscence of a Stock Operator or Ben Graham's The Intelligent Investor and profit from it, even though the markets are very, very different from when those books were published.